Hello and welcome back to CEO.CA's coverage, coming to you live from downtown Toronto. Today, I am joined by Aidan Mills, CEO of Northstar Clean Technologies. Aidan, thanks so much for joining us today.
Yeah, great to be here. Thanks for the time.
So I want to start with an elevator pitch. Can you give us a quick overview? What are the key facts people need to know about Northstar?
Sure. So Northstar Clean Technologies is a Canadian clean technology company. And what we do is we take asphalt shingles that either come from manufacturers or come off people's roofs, divert them away from landfill, bring them into our facilities, and extract the component parts. So an asphalt shingle tile is about 50% sand, 25% fiberglass, and 25% asphalt. And we break the shingle tile into its individual component parts and sell all of those individual component parts into industrial markets, often to our key partners.
Thanks a lot for that overview, Aidan. It's quite an interesting niche market you're operating in. Could you give us a sense of what is the market size here for recycling and repurposing these shingle tiles with your proprietary technology?
Well, that's one of the things that kind of, I joined the company 3 years ago, and that's one of the reasons that I joined. The market size here is absolutely huge. So if you look at North America, the figures for North America, around 16.5 million tons of shingles per year go into landfill, which is absolutely huge. As you said, we've got a proprietary technology, and when our Calgary facility is built, and operating in the middle of next year, we expect to be the only commercial facility in North America that's actually reprocessing shingle tiles.
And could you give us a sense, so operating with this new technology, give us a sense of maybe, is there any risk of new competitors emerging, or who are some of the incumbents operating in this space, or is currently none of this material being processed?
Well, look, I mean, so if you Google RAS or recycled asphalt shingle across North America, there's some areas where people will be taking shingle tiles, grinding them up, and putting them into paving, and so that's an established that's a kind of an established technology. But you can only put a certain percentage into roads, and kind of it depends on the state. And in some states and some provinces, it's banned. So for us, it's brilliant because actually we break it down into the individual component parts. So the sand can go back into roads or into shingles. We expect that the fiberglass and paper can go into concrete. And the asphalt, which is the key element produced by us, can either go into flat roofing, it can go into paving, or it can go into shingles, and is so 100% circular. Nobody else has developed the technology to be able to do that today.
Okay, excellent. And you mentioned the Calgary facility that is currently under construction that you're partnered on. Walk us through what's the significance of the construction of this project, and what are some of the timelines for it actually ramping up to production?
Yeah, so for Northstar and for any investor, this is absolutely pivotal for the company because this is the first commercial facility. So we've spent kind of 3 years de-risking the engine or the process, and that's been done with partners, manufacturers, our engineering company, and also by using the pilot plant that was built in Delta and BC. But this is the first commercial facility of its kind. And the timeline, so it's constructing right now. And we have a video series going out that kind of outlines the construction of the facility. So constructing right now, expected that construction to be finished in early 2025. And then we'll move into, of course, the kind of commissioning and ramp up. And we expect the facility to be at kind of full operating tilt by the middle of the year.
Great, certainly a significant undertaking, and sounds like you're very close to that ramp up stage. I guess when you're fully ramped up, what's the capacity of this processing facility, and will you be the sole operators of it, or is there another partnership agreement in place?
No. So the key thing for these facilities is feedstock and offtake. So feedstock, we're in great shape. So we have manufactured waste coming from ICO. We have a supply agreement from Eco Recycling. And when we open in the middle of the year, when we're at full production, we'll open to third parties, which will be roofers and the public, etc. So that'll be the supply. The offtake, 100% of the offtake is taken on the asphalt side, is taken by McAsphalt. So they're one of the biggest asphalt pavers in Canada, and they're a subsidiary of Colas, the international asphalt company. So fantastic offtake partners and fantastic supply partners. The base capacity of the facility will be 40,000 tons per year. But if we have more shingles available, we have the capacity to run up to 80,000 tons a year without any additional capital. So that's just by literally putting on night shift and running the facility 24 hours a day. And so the potential of the base case, 40,000 tons a day, or sorry, 40,000 tons a year, and the upside case, 80,000 tons per year.
Okay, great. That's certainly exciting to hear that you can double that capacity without any additional capital expenditure. I guess on the finances side, capital-intensive projects, building these production facilities, and obviously going through a long period of research and development as well. You've had some financing from various different channels in terms of royalty financing, government grants, I believe, raising some debt. Walk us through, what are your finances looking like at the moment? How are you able to secure this, I believe, $67 million in financing over the last few years?
Yep. So if we kind of break the financing down in terms of the overall financing, so I joined 3 years ago on the IPO, and that was $12.2 million. And since then, we've raised $55 million, and of that 55, 30 is non-dilutive, and the non-dilutive has come from Emissions Reduction Alberta, and over $7 million from them, and that's a government non-refundable loan. 8.75 from BDC, the Canadian bank. CVW, the most recent royalty financing, was for $14 million. And then even when we've done equity, one of the biggest chunks that we did strategic equity with TAMCO, one of the biggest shingle manufacturers in the US. And we secured that with a market price at the time of 15 cents, and we secured that at 29 cents, so almost kind of a 100% premium with a major strategic investment. So the good thing about it is we've not only have we financed, but we've introduced significant partners into financing. BDC, TAMCO, CVW, etc., which has been fantastic. Calgary is completely funded. So when you take the BDC funding, the Emissions Reduction Alberta funding, and the strategic equity from TAMCO, completely funded. And with the CVW funding, which was done about 6 weeks ago in September, that enables us to develop the next 3 facilities for 2026. And give us solid cash flow through to the end of 2025. So no equity raising needed, between now and the end of 25, if at all.
Great. And in terms of the revenues that you're bringing in, there are 5 core streams, as I understand it: the offtake of fiber, aggregate, and liquid asphalt. But also there's the tipping fees and carbon credits. It's an interesting mix of revenue streams. Are there any that you are prioritizing, or any that have maybe the most growth potential?
Yeah, so as you say, James, the 5 revenue streams are: the first is obviously the tipping fee, and so just for for investors who aren't used to businesses that get paid for their feedstock, which is incredible for us, of course. So when you bring a ton of waste anywhere in North America to the landfill, you have to pay for it. So a tipping fee is basically where we discount the fee that we get paid versus a landfill. So for example, in Calgary, tipping fee $115 a ton. We'll charge something like $90 a ton for somebody who drives up to the front gate to drop off shingles with us. And so that's where the first revenue comes from. And it's probably about, when you look at the economics, probably kind of 30 to 35% of the economics of a facility. Out the back end, as we've said before, comes sand and asphalt and fiber. So older tiles, it's paper; newer tiles, it's fiberglass, and all of those 3 products can get sold into the marketplace. The one that is kind of 95% of that value is the asphalt. So that is by far the most valuable product. And as I said, into flat roofing, into shingle manufacturing, and back into road building. And then the last part is important. So when we did the kind of engineering at the beginning, we did the analysis of the life cycle analysis. So we measured our carbon footprint versus the carbon footprint of the base case. And the base case is take a ton of shingles, put it into landfill, and then replace the hydrocarbon content, so the quarter of a ton of asphalt from virgin production. So that's really good. That's got a carbon footprint of about 200 kilograms per ton going into landfill. Our facility, from the engineering study, was was around 77. So that is a 60% reduction in terms of carbon footprint. However, as you know, for a carbon footprint, you have to make sure you've done a detailed analysis, detailed measurement, a protocol has to be in place, etc. So that's probably about 18 months away from after the operation of Calgary starts. So not until kind of, early 27. So in the commercial model, when we think about the revenue that this generates, we've zeroed the carbon credits out. It's really not it's not a revenue stream that we've banked at all, because it's really important for investors to understand this is a manufacturing business with significant ESG upside, rather than it's an ESG business that manufactures and we need like $100 carbon to make the thing work. This works without carbon credits. And look, from the Calgary facility, and when operational, at the base case of 40,000 tons per year, we expect to generate a revenue of about $10 million and an EBITDA of about 5. Again, if we, as we said earlier, if we double the capacity without having to spend any more capital, we should be able to double those economics to $20 million worth of revenue and $10 million worth of EBITDA per plant.
Fantastic, Paul. Certainly an interesting mix there, and I guess good to hear that those carbon credits are perhaps maybe a down the line sweetener rather than the backbone of the economic model you're applying.
Exactly.
In terms of scaling up here, you mentioned in 2026 there might be more growth plans. Walk us through, okay, when Calgary's up and running next year and everything's going smoothly, what comes next?
Well, so that's one of the things that the CVW financing has really helped for, and that's to have the working capital to be able to drive and accelerate the expansion for 2026. So as we think about 2026, the 3 expansion locations are number one, to retrofit the pilot plant area in Delta, so in Vancouver. So take the pilot plant out and put the new, retrofit that with a new commercial plant. The second location that we're looking at is the GTA, so over by you guys in Toronto, so kind of the first GTA location. And the third one is, so with TAMCO, one of the key things with the deal with TAMCO was not only the strategic investment, but it was also a 4-plant offtake deal in the US. And so what that means is TAMCO have guaranteed the offtake for the first 4 facilities that we build in the US. So we've worked with them to determine where that first one is, which is the best plant to supply them at. And that's going to be their plant in Maryland. So it's likely our first US facility. And so now we're doing the site searching and the site development work for the supply for that Frederick, Maryland plant. And that's likely to be on the Atlantic East Coast of the US. All of these facilities, as we chatted about earlier, all of these facilities have the potential to be the kind of 80,000 ton per year facilities. And all of these facilities, we hope with the acceleration with the TAMCO investment, to have those developed and kind of ready to construct in 2026. So in a perfect world, we'll leave 2026 with 4 operating facilities.
Fantastic. And when you're doing that site searching that you mentioned, what are some of the criteria you're looking at? Maybe what's the catchment area, so to speak, for one of these new facilities, and what might the cost look like for construction?
Yeah, so the way we determine the criteria is kind of really twofold. As we said earlier, the economics is driven by 2 things. So one is the tipping fee and the other one is the asphalt price. So if we think about that kind of top quartile, it's areas that have high tipping fees and high asphalt prices. if you think about 16.5 million tons going into landfill, and you think about the base case of our facility being 40,000 tons, that's 400 facilities across North America. So that is an outstanding size of a market. So we've got a lot of choices. We kind of, narrow in on what we're going to do. And each plant's about 15 million bucks worth of capital and about 5 million of associated costs. And that's kind of like, the development fees, early lease fees, kind of government public affairs, work permitting, etc. And so that's what we think we can build it for. And ultimately, a city anywhere between 1 to 2 million people, we can build one of these facilities and divert 40 to 80,000 tons away from the municipal landfill in that city.
Great. Well, certainly a lot of expansion opportunity. I guess just to wrap up, Aidan, for any viewer of this video who might be wondering, is there anything we've missed? Is there anything else I should know about Northstar? Could you maybe paint a picture for us from an investor's perspective, and why is now an interesting time for somebody to start paying attention to the story?
So yeah, look, I mean, I think, James, in summary, we've kind of covered it in the call today, which is great. Which is, number one, this market size is absolutely huge, 16.5 million tons going into landfill across North America, and we're the only commercial technology available today to solve that. The markets for our offtake products, especially the asphalt, going back into shingle manufacturing, going into paving, and going into flat roofing is unlimited. There are multi-billion-dollar companies who need low carbon products, and as I said, with our carbon footprint, this is extremely low. So this is a manufacturing business that has huge ESG upside because of the low carbon footprint. Look, this is absolutely pivotal. This is the time. I mean, every CEO says this is the time to acquire the shares, but from my point, this is absolutely the time to acquire the shares because the first commercial facility is being built and will come online by the middle of next year. And there's a fast follow-up with that with the next 3 facilities in kind of Vancouver, the GTA, and our first US facility. And then if you think about the growth rate after that, I mean, by 23 plants by 2030, everybody can say, well, it's a bit of a CEO arm wavy hockey stick. But to deliver what the industry needs by 2035, they want 200 plants to solve this problem. So I think we're positioned brilliantly, not only in the immediate term with respect to delivering of the Calgary facility, but also in the long term and the growth that we can bring.
Fantastic. Well, Aidan, sounds like there are exciting times ahead for Northstar Clean Technologies. Looking forward to more updates over the coming months. Thank you so much for joining us today.
Thanks, James.